was a tough year for some emerging markets, but it could be time to start looking at recently beaten up markets like China, Brazil, and Russia. With that, which emerging markets offer the best opportunities next year? Will emerging markets outperform the U.S., or will U.S. stocks maintain their safe haven status? Joining me now is Paul Attwood, Portfolio Manager of the Huntington Global Select Markets Fund. Paul, welcome back to the Wall Street Report. It's good to see you.
Thanks, Jennifer. Thanks for having me.
So what's your outlook for emerging market equities in 2013? Will they fare better than this year?
Yeah, I think so, and there's a few reasons for that. One is that we have valuation on our side. With the emerging markets, we're looking at roughly around 10 times the next 12 months estimates, so 10 times 2013 estimates. We also have an easing cycle in most of the emerging countries, Southeast Asia and Latin America. And then we also have sentiment on our side, where we have a very negative sort of view from most investors, which typically has led to substantial gains.
So do you think emerging market stocks will outperform U.S. stocks in 2013?
I think they have a good shot at outperforming for a couple of reasons. One is, like the three variables I mentioned earlier. They're on an easing cycle. There's a lot of uncertainty in the U.S., obviously, as we've all heard about the fiscal cliff. We have the debt ceiling coming up. But then also, even though valuation, for instance, on the S&P 500 is pretty good, it's fairly attractive, we also have profit margins at very high levels. So you'd have to make the assumption that profit margins can go even higher from here to keep driving stocks. So I think that the potential for emerging markets to outperform in 2013 is pretty high.
Which emerging markets offer the best opportunities for the year ahead?
Okay, so the areas that I'm looking at are the ones that really did not perform very well this year. Primarily, I'm looking at Brazil, I'm looking at China, Indonesia, and South Korea. I think those are areas that really offer exceptional valuation, but I also think that they still have very good long-term secular trends in place, even though their performance this year has been below the benchmark for the most part.
I want to push back a little bit on China because the Shanghai has really been oversold since I'm hearing since September. You know, we're now in December. You know, what's it really going to take to move the needle here on the Shanghai? What's it going to take to get investors believing in the Shanghai again?
I think it's a couple of things, and it's a couple of things that happened this week. On Wednesday of this week, we had an over a 2% rally in the Shanghai Composite, and that was based mainly on some more details on a stimulus package coming out of the regime over in China. And I think that, you know, performance sort of leads to performance in a lot of these markets. Investors have been very concerned about China and the economy over there for some time. And I think that's kind of going away. The other thing is we had an IPO yesterday over in Hong Kong of a Chinese-based insurance company, which was very well accepted, very well received, and did very well on the opening. And I think those are signs to show that maybe the optimism is coming back a little bit.
All right, you mentioned Brazil. Let's talk about Latin America, because there seems to be a tale of two different economies there, with nations like Peru, Colombia, Mexico, and Chile actually growing faster than Brazil and Argentina. Do you think that that trend continues next year?
I think there's always a potential for those countries to grow a little bit faster because of the size of the economies are obviously dramatically lower. So just from a large number perspective, that's always a potential. What we've been doing in the Global Select Markets Fund over at Huntington is we've been focusing on countries that we think have a long-term secular trend in place, of which Brazil would be one of those. Brazil this year has not performed very well. However, if you dig deeper into the index, and the way that we have been playing it this year is we've been tilted much more towards the consumer in Brazil. So we own names in the retail sector that have done exceptionally well this year. That's largely due to the fact that you have a very low unemployment rate, you have earnings increasing, and you also have things like good retail sales and some positive momentum in those areas. The areas that have struggled the most are the ones that would be the exporters, particularly to nations like China. So obviously, you know, it's the old thing. If China sneezes and, you know, a country like Brazil catches a cold. So as we come into next year, my view is that we are probably going to tilt the fund and the portfolio much more towards the industrial types of names.
What about Mexico? So often we hear about drug wars in Mexico, but the economy's been a real turnaround story, hasn't it? Growing faster than Brazil. The new president-elect has also pledged to boost annual growth to, what, 6% in the next 6 years from an expected 4% this year. Is Mexico the new Brazil?
I don't think so, just because I think Brazil has much more of a resource base, which I think, when you're looking globally, I think is much more valuable. But as you say, Mexico has done a tremendously good job of managing their economy, particularly when most of the developed Western world has really been struggling for most of this year, at least, if not 18 months. There are some areas of Mexico that we're interested in investing in. But I think if I were to choose between, if my choice was between Brazil and Mexico, I would lean much more towards Brazil.
Which emerging markets would you be avoiding next year?
Some of the areas that we've typically avoided are those areas where there's political instability, where there's questionable management of the economy. And ironically, those are some of the ones that have done the best just this year. And there's some of the smaller areas, places like Egypt, Colombia, those types of members of the index, let's say, that will occasionally have a good 12-month period, but we think over the long run, kind of have a little bit too much risk, let's say.
What about India? Because India's economy really has slowed to its weakest level in, say, a decade. It's dealing with slowing manufacturing, inflation, fiscal deficits. The government has tried to attack the fiscal side, launching new policies in September, but that's being met with political opposition. How does all of that bode for investing in India in the next 12 months?
Yeah, that's really a good point, because even though these things have been occurring, particularly on the macro scale in India, it's actually been a very strong performer, particularly in the second part of 2012. There's an election coming up in India in May of next year. They really, from an investor's point of view, have always been considered very bureaucratic, and I think that's part of what you have to put up with when you invest in India. We still like India for the long run. We're a little concerned with the run that it's had this year and some of the valuations. And again, if I had a couple of choices, I would tilt an overweight towards China and an underweight in India.
Within the emerging markets that you favor, Paul, quickly, which companies do you like the most?
I think coming back to Brazil, one of the names that I would take a look at, it's not currently held in the portfolio, but it is one that we're looking to establish a position in, is Vale, which is V-A-L-E. There's an ADR that exists. It's basically an iron ore manufacturer. I think that if we do get some stabilization in global growth, if we do get a pickup in China, this stock could do very well. The downside is very limited, so on a risk-reward basis, it's very attractive. And then I'm always a little hesitant to give individual investors individual stock names, because obviously things are so dynamic at the moment. But maybe an investor could look at a couple of ETFs. I think a couple that would be attractive at this point are FXI, which is the largest 25 market cap names in China. I think that's an interesting way to get exposure to the Chinese market. And then possibly EWY, which is the iShares South Korea, which captures the movement in the Kospi index in South Korea.
Paul, thanks so much for weighing in. Happy holidays.
Thank you. It's my pleasure.